Good afternoon. Welcome to Brookings, Economic Studies Center on Regulation and Markets, second in the series on the future of financial regulation. My name is Aaron Klein. I'm the Miriam K. Carliner Chair and Senior Fellow in Economic Studies here at the Center on Regulation and Markets. When thinking about the future of financial regulation, it is illustrative to start by looking at the past. One thing you will find in American history is we are littered with financial crises. Another thing you will find is that often these financial crises produce financial regulators meant to ensure the safety and soundness of the financial system and maximize economic growth going forward. Over this time, perhaps the single greatest financial crisis was that of the Great Depression, which spawned the establishment of the Federal Deposit Insurance Corporation in 1933, nearly a century ago. And in that 100 years, the FDIC has never lost one penny of an insured depositor's money, an impressive track record for a corporation who has played a seminal role in stabilizing the financial system to a degree post-1933 that was not true for the century before. In that century of the FDIC's existence, no one has served on its board longer than Martin Gruenberg. In fact, in the history of American federal financial regulation, which doesn't really start until the financial crisis of the 1860s, creating the comptroller of the currency, Chairman Gruenberg is the third longest tenured financial regulator in American history. That track record of accomplishment of seeing all of these situations in and of itself would be worthy enough for a lecture series. But on top of that, before joining the board of the FDIC, Mr. Gruenberg had an incredibly distinguished career in Congress, writing many of the statutes, including the Federal Insured Depository Institutions Act, or FDIA, and FIREA, in response to the savings and loan crisis, that in some ways is the last big legal rewrite of the very corporation which he has chaired. So I can think of no person sitting in government today with as long a track record and as much experience in handling financial crises, nor a person more committed to having a future in which the average American gets what they need out of the financial system: a safe place to store their money, the availability for credit, which is the lifeblood of opportunity, and trying to know that their family's nest egg is safe and secure, and that you have a banking system whose goal is to work for the customers of the bank and for the American good of the greater American society than for the executives of that bank. And that track record and that core fundamental ideology and vision of a public servant, coupled with his illustrious and unparalleled and unmatched record of experience, is why I think we are all here in person and online so eager to hear his thoughts on the future of financial regulation based on the lessons he's learned from the three major crises of his experience. So with that, please join me in thanking and welcoming Chairman Gruenberg.
Good afternoon, everybody. Thank you, Aaron, for that very generous introduction. You can tell that Aaron and I have worked together for a long time. This is a terrific opportunity for me that I really welcome as I conclude my service at the FDIC. As Aaron pointed out, I have been around a long time, nearly 20 years at the FDIC, pardon me, and before that, nearly 20 years on the staff of the Senate Banking Committee. So I've been around actually going back to the thrift crisis of the late 80s and early 90s. I participated in writing the S&L bailout legislation of 1989 for RIA. And I was vice chairman of the FDIC during the global financial crisis of 2008 when we sort of bailed out everybody. And I was chairman of the FDIC a little less than 2 years ago when we had to deal with the failures of 3 large regional banks that they call it the banking turmoil, but it certainly had the potential, frankly, to be far worse. So if nothing else, I have a lot of perspective to bring to bear. I don't know if I have wisdom, but I do have perspective. And thank you. And as I thought about what I might want to share as I leave the FDIC, I thought the most useful thing to do from my standpoint was to share some of that experience and the lessons, at least that I take away from those 3 episodes. And they are the following, and now I'm going to start reading this speech. I'm struck by the commonality of the causes of these crises: interest rate and liquidity risk, concentrations of assets and deposits, leverage, rapid growth, inadequate capital, new activities and products whose risks were poorly understood, interconnection with non-bank financial companies, poor bank management, and failures of supervision and regulation to identify and address those risks, and in some cases, exacerbating them. So as I leave the FDIC, I thought there might be value in sharing some of the lessons of that experience as we head into a period of uncertainty about the future path of financial regulation in the United States and globally. In particular, I offer the observation that while innovation can greatly enhance the operation of the financial system, experience suggests it be tempered by careful and prudent management and appropriate regulation and supervision. So I'm now going to walk you through, at least from our standpoint, the experience of these 3 crises. And just as a word of warning, I really wanted to make an effort for the record to lay out in some detail what occurred in each of these episodes. So I would not describe this speech as a light lift or a barn burner in any way. So I hope you'll stay with me as I work my way through it. But I think understanding the record here of what's occurred in the past, and not just once, not just twice, but 3 times, is worth understanding. So, if I may, let me start by going back to 1980, when the banking and thrift industries in the United States had experienced more than 4 decades of stability. After the reforms of the Great Depression, which included the creation of the FDIC in 1933, as Aaron referenced, banking became a steady, perhaps even boring business. I will say, from my standpoint, as it regards banking, as a general matter, boring is good. From the end of World War II to 1979, only 160 depository institutions failed, or fewer than 5 per year over a 45-year period. That stability was in large part due to a combination of laws that heavily restricted competition in banking, including caps on deposit rates, restrictions on branching in interstate banking, and restrictions on what types of products could be offered. In fact, the 90-year history of the FDIC can be neatly divided into its first 45 years from 1933 to 1978 and to the 45-plus years since, and it's that latter 45 that I'm going to focus on today. Starting in the late 1970s, banks and thrifts were facing a new type of competition from what we would later call shadow banking or non-bank financial institutions. The new flavor at the time were money market mutual funds, which offered deposit-like products but paid higher interest rates than banks at that time were allowed. In 1975, these money market funds held about $3 billion in assets. 6 years later, they held about $150 billion. This is one of the lessons that things can change fast and risks can grow if you don't pay attention. Compared to the roughly $200 billion of deposits at thrifts and $1 trillion of deposits at banks, this was a meaningful amount of competition from these enterprises. In 1980, Congress passed the Depository Institutions Deregulation and Monetary Control Act, which removed many of the interest rate caps that limited what banks and thrifts could pay on deposits. The act was in part a response to interest rate increases by the Federal Reserve to control inflation. And while the act helped banks deal with money market fund competition in a rising interest rate environment, it also made it easier for banks and thrifts to take on brokered deposits and other forms of hot money. So let me first turn to the thrift crisis and then to the banking crisis. Thrifts in particular at that time faced difficulties due to their large portfolios of fixed-rate mortgage loans. Many of them, as a result of the interest rate increases, were insolvent on a mark-to-market basis. In 1982, in response to that difficulty, Congress passed the Garn-St. Germain Act, which removed many of the safeguards on thrifts in an effort to help them improve their profitability. The act let thrifts increase their investments in areas where they had little experience, including commercial real estate and consumer loans. Many thrifts, as it was called, gambled for resurrection by expanding rapidly and taking on risk in an attempt to earn their way back to solvency. Thrifts were also allowed to count so-called net worth certificates and increased amounts of goodwill toward their regulatory capital, even though those instruments carried no real economic value. I have to say I was around at the time, and I have a vivid recollection of that. Unfortunately, the agency that supervised the thrifts at that time, the Federal Home Loan Bank Board, was largely ineffective. Approximately 1,300 thrifts, almost one-third of the industry, failed between 1980 and 1994. Deposit insurance for thrifts in those days was in a separate fund administered by the Federal Savings and Loan Insurance Corporation, known as FSLIC was the acronym. Those failures of thrift institutions cost the taxpayers an estimated $132 billion at the time. That's in 1980s dollars. While certain deregulatory measures were appropriate for the thrifts to navigate their interest rate-induced losses, it is clear, in retrospect, that the manifestation of risk in one area can't be dealt with by deregulating other types of risk-taking, which is what occurred with the Garn-St. Germain Act. Moreover, in a deregulatory period, strong and effective supervision is indispensable. The forbearance and accounting manipulations that were permitted at that time simply created future challenges. So now let me turn to the bank crisis. We managed to put both the thrifts and the banks into crisis at the same time, which is a rather impressive, you tell me what to call it. As the thrift crisis unfolded, banks also were encountering their own challenges. Many of them had overinvested in commercial real estate and the energy sector and were severely affected by regional recessions in the early 1990s. Between 1980 and 1994, more than 1,600 banks failed. In 1990, for the first time, the FDIC's deposit insurance fund balance went negative. The 1980s also saw the failure of Continental Illinois National Bank and Trust Company, which is often considered the first too-big-to-fail bank. It was the seventh largest bank in the United States at the time and had grown rapidly by participating in risky loans, particularly in energy, and funding the activity through brokered deposits. Most of those deposits were uninsured and started running quickly when questions emerged about Continental's viability. Does any of this ring a bell to anybody here, just out of curiosity? When Continental suddenly collapsed in May of 1984, rather than place the bank into receivership, it was supported by an equity injection from the FDIC and a consortium of other banks, extensive borrowing from the Federal Reserve's discount window, and a blanket guarantee on its uninsured deposits and general creditors by the FDIC. Not for the last time, regulators were forced to make a difficult choice between averting systemic risk on the one hand and making shareholders and creditors of failed banks bear losses on the other. So what were the responses to these episodes? In 1989, Congress passed FREA. Some of you may be familiar with that, the Federal Institutions Reform, Recovery, and Enforcement Act. That act abolished FSLIC, the Savings Deposit Insurance Fund for the thrifts, transferred the deposit insurance responsibilities for thrifts to the FDIC, and created the Resolution Trust Corporation to manage the assets received from the failed banks. In the Federal Deposit Insurance Corporation Improvement Act of 1991. The acronym is FDIC for any of you who are familiar. Congress reined in the use of forbearance by the regulators on both large and small banks. FDIC created the Prompt Corrective Action Framework, which forces regulators and banks to take corrective and remedial actions when capital ratios fall. It also put in place the least cost test, which limited the FDIC's ability to protect uninsured depositors and other creditors. FDIC also created a framework in which the banking industry is responsible for recapitalizing the FDIC's Deposit Insurance Fund so that taxpayers would no longer be on the hook. Now, after this turbulent period, the banking industry recovered and expanded in the mid-1990s. When I joined the FDIC board, hard to believe, back in 2005, the FDIC was in the midst of more than 2 years without a bank failure, the longest such period in the FDIC's history at that time. The number of problem banks was approaching historic lows. Strong loan growth helped insured banks set 6 consecutive annual earnings records from 2001 through 2006. This is a true story. Banking conditions seemed so favorable that friends asked me at the time if I really wanted to become a member of the FDIC board. After all, nothing was happening in the banking industry, and I might get bored. This was in 2005. Not a problem. Unfortunately, this tranquility masked an enormous increase in risk-taking that would soon lead to the deepest financial crisis since the Great Depression. In retrospect, it became clear that the federal banking agencies, the Federal Reserve, the OCC, and the FDIC, did not appreciate the full extent of these risks, and the bank regulatory framework was ill-suited for the challenge. Risks were amplified and masked through banks' interactions with less regulated non-bank institutions. The pre-crisis rules allowed, and in some cases encouraged, activities that fueled a housing bubble and contributed to the collapse of the financial system. Now, before the crisis, there was a movement to expand the activities of both securities firms and bank holding companies. Investment banks became publicly traded and expanded their business model from advising and underwriting equity and debt to also include trading, investment, securitization, and derivatives. The Gramm-Leach-Bliley Act of 1999 removed restrictions across the financial sector. The largest bank holding companies became major players in investment banking by establishing or acquiring securities firms as subsidiaries. Some argued that financial institutions had strong incentives to protect shareholders and would regulate themselves by managing their own risk. There was opposition to imposing limits on bank activities or growth. From 1998 to 2007, the assets of the 5 largest U.S. banks grew from $2.2 trillion to $6.8 trillion, more than tripling in that time. As the scope of financial institutions' activities grew under the Gramm-Leach-Bliley Act, banking regulators were limited in their ability to directly examine or require reports from subsidiaries which are regulated by other agencies. These policies made it difficult for any single regulator to see the entirety of a financial firm's activities. Further, regulatory mandates primarily focused on risk to individual institutions rather than on the risks that develop across and between markets and institutions. These regulatory factors contributed to some of the key drivers of the 2008 global financial crisis. These included deterioration of lending standards, particularly in the mortgage market, amplification and concentration of exposures to the mortgage market through securitization and derivatives, inadequate capital, and the deep interconnectedness of the financial system. And let me briefly walk through each of these. The nationwide, first with the mortgage crisis, the nationwide housing expansion of the early 2000s was rooted in a combination of factors, including a prolonged period of low interest rates. By mid-2003, both long-term mortgage rates and the federal funds rate had declined to levels not seen in at least a generation. One response to low interest rates was an acceleration of U.S. home price appreciation to double-digit rates for the first time since 1980. Another response was a series of mortgage market developments that dramatically weakened credit standards in mortgage lending. This was a toxic combination. As housing prices increased, mortgage underwriting standards deteriorated. Mortgage origination became less of an income-based credit decision and more reliant on continued appreciation in housing prices, an inherently problematic practice. The subprime mortgage securitization pipeline allowed risky mortgages to be packaged and sold throughout the financial system. That originate to distribute model undermined accountability for the long-term viability of mortgages. Modest attempts to curtail risky lending activities through regulatory guidance were met with significant resistance from the industry and Congress. Such efforts were often thought to stifle what was then viewed as innovation. For example, banking agencies' guidance on risks and concentration in subprime lending issued in 1999 and 2001 was met with severe criticism for being overly restrictive. Relatively unchecked, subprime mortgages grew from 8.2% of mortgage originations in 2003 to 23.5% of originations in 2006, nearly tripling in 3 years. The demand for securitized mortgage products increased, and the capital held against these exposures was entirely inadequate. Rules for risk weights combined with inflated credit ratings allowed banks to reduce the capital they held against those risky mortgages. Furthermore, banks did not hold capital against off-balance sheet exposures to the housing market, for example, through their sponsorship of structured investment vehicles, or SIVs as they were called. I can remember this stuff. This fueled growth in the private label mortgage-backed securities market and allowed the banks to increase their leverage. From 2000 to 2007, risk-weighted capital ratios were virtually unchanged for the largest banks, even as the risk grew. And leverage ratios declined from 7% to 5.5%. Capital requirements outside of commercial banking were even weaker, and institutions were more highly levered. The balance sheets of the 5 largest investment banks expanded by $1.8 trillion from 2004 to 2007, heavily increasing their exposures to the mortgage market and reliance on short-term funding. This resulted in leverage of more than 40 to 1 by one measure at year-end 2007. I'm not making this up, by the way. This capital remained overstated as the housing bubble began to burst because accounting rules enabled institutions to mask exposures and losses. Mark-to-market accounting rules in 2007 required financial institutions to write down losses to certain assets. However, many of those assets were illiquid and had little to no discoverable market prices. Nobody wanted them, so there were no prices available, increasing the uncertainty of their valuation. Marking to model, or marking to make-believe, as some called it, allowed banks to overstate their capital position. As if we didn't have enough problems, at the same time, unregulated growth in the shadow banking sector further fueled the boom in the mortgage market. The use of mortgage-related securities as collateral in the asset-backed commercial paper and repo markets increased the demand for mortgage-backed securities to support those short-term funding markets and made those markets vulnerable to freezes. When property prices began to soften, uncertainty in the valuation of the mortgage-backed securities that was being used as collateral rose, and financial institutions reliant on that collateral suddenly lost access to short-term funding. As the mortgage market became overextended, continued demand for highly rated assets and declining demand for the riskier tranches of mortgage-related securities incentivized so-called financial engineering of new products. Some of you will remember these, such as collateralized debt obligations, CDO squared, synthetic CDOs, and credit default swaps that fueled the demand for continued securitization of non-prime mortgages. At the time, this financial engineering was considered a form of innovation. Lack of regulation of the over-the-counter derivatives market as a result of the enactment of the Commodity Futures Modernization Act of 2000 allowed many firms trading these products to operate with no capital, no margin, no reporting requirements, and exposures grew rapidly. For example, the notional amount of credit default swaps grew by more than 100-fold from 2000 to 2008 to over $60 trillion. So in hindsight, everything's clear in hindsight, not so much in the moment. In hindsight, the interconnectedness of the system was significant and underappreciated. As the housing market collapsed in the fall of 2008, the financial crisis deepened. Investors and counterparties struggled to understand the opaque distribution of mortgage-related securities losses across the financial system. The opaqueness of the nature and size of exposures, particularly derivative exposures, combined with the heightened leverage embedded in the system, resulted in a dramatic seizing up of credit markets as market participants looked to minimize or eliminate exposure to potentially vulnerable counterparties. The system had nearly collapsed. The systemic threat posed by the crisis called of necessity for a forceful public response. The government's initial plan for the Troubled Asset Relief Program, or TARP as it was called, to buy mortgage-backed securities to support the market proved to be less effective than hoped. So U.S. authorities looked for other tools to help stem the panic. On October 13, 2008, I candidly remember that date, the FDIC, the Federal Reserve, and the Treasury announced a package of 3 unprecedented actions, interventions in the financial system. The first called for the Treasury to use the TARP program for capital injections rather than asset purchases. Those are injections of public money into private institutions on an open institution basis to keep them from failing. And you all know the word for that. The second action was for the Federal Reserve to establish a widely available commercial paper facility to facilitate liquidity. The third action, I had to vote on this, by the way, called for the FDIC to use the systemic risk exception under the Federal Deposit Insurance Act to establish what was called the Temporary Liquidity Guarantee Program. That program included a debt guarantee program, which guaranteed certain senior unsecured debt issued by eligible institutions, and a transaction account guarantee program, or TAG, which fully guaranteed non-interest-bearing transaction deposit accounts above $250,000. This was an unprecedented intervention by the government authorities into the financial market to support the market and prevent its collapse. And in fact, those actions did help to calm market fears and eventually restored financial stability. Now, let me make an additional point that's worth keeping in mind. In addition to these extraordinary interventions to prevent the failure of large institutions and the financial system itself, from 2008 through 2013, nearly 500 banks failed, including the largest failure in the FDIC's history, Washington Mutual, with $300 billion in assets. Those failures would eventually cost the Deposit Insurance Fund nearly $70 billion. Most of these failed institutions were community banks, often in parts of the country where the subprime mortgage crisis and the recession made real estate problems more severe than elsewhere. So, in addition to the enormous economic and human cost of this crisis, almost 9 million jobs lost, 12 million homeowners facing foreclosure, and an estimated $10 to $15 trillion in lost GDP. It also highlighted 2 related aspects of how failing banks were handled in the United States. The first and most obvious is the problem of too big to fail. When the largest banks were on the brink of failure, the authorities provided them extraordinary government assistance on an open bank basis rather than allow them to fail. This meant that their shareholders and creditors were not exposed to losses, and senior management was not held accountable. It also meant that uninsured depositors at these banks were fully protected. The second and related issue was the disparate treatment between large and small institutions. When community banks and smaller regional banks were undercapitalized, they were closed. Their shareholders and creditors were wiped out, and management was replaced. And while in the majority of these cases, the acquisition by another bank under the least cost test resulted in no loss to uninsured depositors, that wasn't always the case. And so for practical purposes, only uninsured depositors at smaller banks face the risk of loss. So we had a lot of lessons to learn from this episode, almost more than you can count, quite frankly. And there was a meaningful post-crisis response. The Dodd-Frank Act, enacted in 2010, addressed many of the regulatory gaps that surfaced in the crisis and in many ways expanded the options for crisis management. Title I of the Dodd-Frank Act subjected large bank holding companies to heightened prudential standards, including higher risk-based capital requirements and leverage limits, liquidity and risk management requirements, and resolution planning. And specifically with regards to resolution, which is obviously of particular relevance to the FDIC, Title I of the Act required the largest bank holding companies to provide a plan for their rapid and orderly resolution under the U.S. Bankruptcy Code, and Title II of Dodd-Frank provided the FDIC with dramatically expanded authorities to manage the orderly failure of a U.S. global systemically important bank, or for that matter, any financial company whose failure was deemed to pose a risk to U.S. financial stability. And Title VII of that Act, importantly, required the clearing of standardized derivatives through central counterparties and established significantly strengthened margin requirements for most over-the-counter derivatives. One final point. It is important to recognize that Basel III is an effort by the U.S. banking agencies to strengthen the banking system because our nation's largest, most systemically important financial institutions were found to be woefully undercapitalized and over-leveraged in 2008. The early round of Basel III changes significantly improved the quantity and quality of capital held by internationally active banks. The four critical areas of risk addressed by the remaining final phase of Basel III, which is pending: credit risk, market risk, operational risk, and the risk associated with financial derivatives, are a direct response to the experience of 2008. So finally, let me turn to the most recent episode with which we all may be more familiar than we would like. The focus on GSIB, Global Systemic Important Banks, on GSIB capital standards and resolution, while entirely appropriate in the aftermath of the global crisis, meant that less attention was paid to the risks associated with the failure of a large regional bank. In 2019, I actually gave a speech here at Brookings pointing out that the resolution of a regional bank could cause significant systemic risk, that regional banks were highly reliant on uninsured deposits, and underscored the importance of devoting appropriate attention to their supervision and resolution. In 2018, however, Congress passed the Economic Growth, Regulatory Relief, and Consumer Protection Act. That law rolled back some of the safeguards that the Dodd-Frank Act had put in place after the global crisis by granting the Federal Reserve discretion to increase the asset threshold for many prudential requirements from $50 to $250 billion, essentially freeing banks in that space from those requirements. Capital, liquidity, and stress testing requirements were substantially reduced for banks in that range, precisely the banks that failed in this episode. In addition, the threshold for submitting Title I resolution plans or living wills was raised to $250 billion under the authority given to the Fed, and the FDIC placed a moratorium on bank-level resolution plans for regional banks. So, in March of 2023, Silicon Valley Bank of California, with over $200 billion in assets, then the 16th largest bank in the United States, experienced a bank run. SVB, as it was called, relied on a deposit base with 90% uninsured deposits, invested in long-term government securities, and had expanded rapidly, tripling in size in the preceding 2 years. As interest rates rose, the market value of the bank's assets, those long-term government securities, fell. When the bank sold its portfolio of securities at a large loss to raise liquidity, the bank experienced a big hit to its capital, and uninsured depositors withdrew en masse. When SVB was closed mid-morning on Friday, March 10th, another date that I recall well, the FDIC initially planned to pay out its relatively limited amounts of insured deposits, provide the uninsured depositors access to a portion of their funds, and begin marketing the rest of the bank's operations. That plan was in line with the Federal Deposit Insurance Act's requirement that the FDIC choose the least costly manner of resolving a firm. However, the prospect that uninsured depositors at SVB would experience losses alarmed uninsured depositors at several other regional banks with heavy concentrations of uninsured deposits, and depositors began to withdraw funds. Signature Bank of New York, in particular, experienced heavy withdrawals and was closed on Sunday, March 12th, a couple of days after SVB. Faced with growing contagion in the financial system, a systemic risk exception was invoked for both of those institutions, protecting their uninsured depositors. That allowed the FDIC to organize bridge banks for their operations and buy some time to find potential buyers. And these actions did calm the market. When First Republic Bank of California, which had a 70% reliance on uninsured deposits, failed on May 1, the FDIC was able to resolve that bank using its ordinary processes without recourse to the systemic exception. These bank failures were the second, third, and fourth largest in U.S. history, although it's worth keeping in mind that's because when some of our largest institutions were at risk of failure in 2008, far larger than these banks, they were bailed out. The decision to recommend a systemic risk determination was not an easy one, I can tell you that. I think it was justified by the contagion risk of the moment. Although I would note, and I think this is important, that both Silicon Valley Bank and Signature Bank were allowed to fail. The shareholders of both were wiped out, and the boards and management teams of those institutions were replaced, but those uninsured depositors were protected. The deregulatory environment of that time didn't help, to be candid. Silicon Valley Bank would not have been in compliance with the full liquidity coverage ratio as it had been applied prior to the implementation of the 2018 law. It was not required to undertake company-run stress testing, and the transition rules under the 2018 law delayed its supervisory stress test despite its rapid growth. Its holding company was not large enough to require a Title I resolution plan because the asset limit had been raised. And the 2018 law also had a chilling effect on supervisors at the time, as documented in the Federal Reserve's analysis of the Silicon Valley failure. During that period, supervision should have been emphasized more, not less, especially due to Silicon Valley's rapid growth and balance sheet concentrations. So in response to that spring of 2023 regional bank turmoil, the FDIC, the Fed, and the OCC have pursued a number of policy responses to try to address those identified risks. After examining our pre-failure supervisory activities, all three agencies acknowledged gaps and the need for more intensive and timely supervision. Interest rate risk, concentrations of unrealized losses on assets, concentrations of uninsured deposits, and rapid growth have been a focus of attention for all three agencies. The FDIC updated its Insured Depository Institution Resolution Planning Rule in June of last year to require a comprehensive plan and resolution strategy from banks with at least $100 billion in assets and more limited informational filing from banks with at least $50 billion in total assets. They would have come in handy in 2023. The three banking agencies also jointly proposed a requirement for banks with more than $100 billion in total assets to maintain a minimum amount of long-term debt that it could absorb losses in resolution ahead of uninsured deposits. That would reduce the likelihood of uninsured depositors to run because the long-term debt would take losses ahead of those uninsured depositors and would perhaps have reduced the likelihood of failure. And even in the event of failure, that unsecured debt would have increased the prospect of the FDIC having resolution options beyond liquidation and would have reduced the cost of failure to the Deposit Insurance Fund. And finally, I'd mention that the FDIC issued a report on options for deposit insurance reform, and the report identifies so-called targeted coverage, which would allow for higher or unlimited insurance for business payment accounts as having the greatest potential for meeting the fundamental objectives of deposit insurance relative to its costs. So what are the lessons we should draw from all of this? As I indicated at the outset, as I look back at these three episodes of financial system disruption, I am struck by how many common threads run through them, even as a specific context and details differ. Interest rate and liquidity risk, reliance on uninsured deposits and wholesale funding, inadequate capital, leverage, rapid growth, poorly understood new financial products and companies, sheer size, inadequate risk management by the banks, and accommodating supervision and regulation have repeatedly forced the hand of the U.S. government to intervene and protect different types of creditors and the firms themselves. I would say that I am particularly concerned with the proliferation of activities of non-bank financial institutions, which I believe pose financial stability risks. The Financial Stability Oversight Council has repeatedly pointed out risks growing from outside the regulatory perimeter, ranging from hedge funds to private credit lenders to non-bank mortgage servicing companies. I do believe we've made progress since the 1980s with improved capital and liquidity requirements, strengthened regulation of derivatives markets, and resolution planning. On the other hand, the largest banks are bigger, more complex, and are deeply interconnected domestically and internationally. So my final point is this. I am concerned that memories are short. We should not allow the current relative stability of the banking and financial systems to lull us into a false sense of complacency. Not only are many people not familiar with the thrift and banking crises of 30 years ago, some seem to have lost sight of the experience of the global financial crisis of 2008 and even the regional bank failures of the spring of 2023. New technologies, new financial products, new kinds of financial companies are part and parcel of the evolution of the financial system that we have experienced before. But we should not kid ourselves into believing that they don't present risks that need to be carefully supervised and, if necessary, regulated. That, to me, is the core lesson of these three financial crises to which I hope we pay close attention. Thank you all very much.
If you'll join me in sitting down and answering, let me ask you a few questions and turn to the audience. That was I think you took us from Banking 101 to 501 in the course of that experience. Let me just pause with a couple comments that you made and start here. You made a comment that financial engineering was considered a form of innovation. I think that was in reference to the 1990s and aughts leading up to the crisis, but perhaps that sentence can be true on all three.
It can be true on all three, and the financial engineering was really a term utilized in the 2008 crisis when it's all particularly, well, look, securitization itself of mortgages was viewed as a form of innovation, and in particular, the derivative products which were developed that I mentioned, the collateralized debt obligations, the CDOs squared, the synthetic CDOs, the credit default swaps, were viewed, as creative financial innovations that would expand economic activity and be of benefit to the country. And people who questioned them at the time, were viewed as, not with it, not understanding, the increased sophistication of financial risk management, embodied in those instruments. And of course, it was all untrue and phony baloney. And those instruments took mortgage-backed, subprime mortgage-backed securities. Subprime mortgages, to call them badly underwritten is probably an understatement. But they were mortgage-backed securities of subprime mortgages, terribly underwritten, enormous financial risk, and those so-called innovative instruments expanded that risk, not only in the United States, but throughout the global financial system.
So if that was the problem then, what keeps you up at risk now? What you're going to, I think, you said your last day is Sunday? I hope Monday is the best night of sleep you get, because the system, your watch will have passed at the FDIC. But yet, I believe you'll be spiritually tethered to those on the wall. And what will keep you up at night about the future of the system going forward?
Well, as I mentioned in the speech, I do have a particular concern about the growth of the non-bank financial sector in the United States. It is large already. It is growing rapidly. It is deeply interconnected to the banking system. And not only is it not really regulated, it's not transparent. So we do not have a good handle on the exposures of those financial companies. And, you know, if you ask me what keeps me up at night, that sort of keeps me up at night. What really can keep me up at night is the prospect of some external shock to the economy and financial system of the United States that could prompt a sharp spike in interest rates. Some of these non-bank financial firms are very highly leveraged, deeply connected to the banking system, and could result, I'm not saying would, I think this is not a high probability, but a low probability, but not an impossibility, as we learned in 2008, that really could start a domino effect of the kind we saw in 2008. Not a probability, but not zero either.
Well, I wrote a...
And one thing we learned in 2008 is to take tail risks seriously. And don't assume they can't happen.
I wrote a paper in 2000, a little while ago in the Yale Journal of Financial Stability, where I said every financial crisis has had the same features of leverage and the fundamental mispricing of an asset. And regulators, to some degree, can control leverage. Markets set asset pricing, and what is fundamentally mispriced? Is it the shares of Netscape or Pets.com, which did not cause a crisis when the dot-com bubble burst, in part because there were serious regulation on stock market leverage? I don't know what the fundamental valuation of Bitcoin is or these other cryptos. I have my own skepticism. So far, the questions there about leverage, that part of the non-financial bank system. You, I think, were referencing a different part of leverage, not as much tied to assets. If that's what keeps you up at night, what are the steps the next people in charge should take to maintain the stability of the financial system?
Well, in the short run, look, we learned some important lessons, I think, from the 2023 episode. You know, interest rates are still high, so the management of interest rate risk, which was central to the 2023 failures, is still very much an issue for financial institutions in the United States. We still have the underlying vulnerabilities that precipitated the 2023 failures. We still have large concentrations of unrealized losses on assets on the balance sheet of banks. The FDIC documents this every quarter in our quarterly banking profile. We had been talking about it well before the 2023 failures. We still have huge reliance by large banks in the United States on uninsured deposits. And adding to that, concentrations in some institutions of commercial real estate with particular vulnerabilities in the office space sector. So it seems to me what will be important is to continue our efforts to strengthen the supervision of those underlying risks, which we didn't do as we should have, you know, in the cases of those three failed banks. And I think there are a couple two or three other things that would be very important to do as a matter of rulemaking. As I mentioned, Basel III is fundamentally a response to the market risk, the derivatives risk of the 2008 crisis. Those activities were woefully undercapitalized in 2008, and we still need to address those risks, which is why it's very important domestically and globally to follow through on the implementation of Basel III. And incidentally, one of the things in Basel III would be to require banks to hold capital against their unrealized losses on available for sale securities, which would have been very helpful in 2023. So that's one. Two, the three banking agencies have a proposed rulemaking outstanding, as I mentioned, to require a buffer of long-term debt to be held by these regional banks. That long-term debt would take losses ahead of the uninsured deposits, reducing the run risk, and if the bank fails, reducing the loss to the deposit insurance fund. If Silicon Valley had been required to hold capital against those unrealized losses, and if it had had a buffer of long-term debt to take losses ahead of those uninsured deposits, and by the way, if we had had a more robust and timely resolution plan for the institution, we might have avoided the failure, which really triggered the whole episode. And even if it failed, the long-term debt would have reduced the cost to the deposit insurance fund, so we might have avoided the need for a systemic risk exception, which it would have been a very desirable thing to do.
So in that situation, the bank would have failed, somewhat analogous to how SVB failed on Friday, without the Sunday exception, triggering some losses to uninsured depositors, but not requiring the full thing. I want to stay on that bank failure point. There's a question that came in through our hashtag before the event, and I'm going to turn to people in the audience to ask questions going forward, from Jim Wigan from Great Point Financial.
Former FDIC guy, by the way.
Who, not surprisingly, wrote a question about bank failure, a question near and dear to my heart, because failure is part of capitalism. A charter to a bank is a very different relationship than a license to operate a business. Charters and licenses are very, very different in their root and in their rationale and in their responsibilities. Nonetheless, a charter is not the grantation in perpetuity to forever run a business if you fail. And Jim asked a question about the need for bank failure as it relates to healthy capitalism and that corresponding role of deposit insurance in that. I wrote a piece recently. I've asked you and I've asked everybody after the SVB crisis, when would be the first uninsured depositor to lose money? And it turned out nobody got that answer right, because the answer was only a few months ago. A small bank in Oklahoma failed, and I want to be very clear that I feel deeply for that community of Lindsay, Oklahoma, and for what that failure meant to that community, and to the very small number of uninsured depositors who lose money. I express tremendous sympathy. Nonetheless, that bank failed and didn't trigger a financial crisis, and went through a normal and orderly resolution. So I want to ask you kind of two related questions. One is, how do you see the role of orderly failures? You made the comment in your speech that in 2005 and 6, when you joined the corporation, no bank had failed for the first time in a year in American history. 2 years. And I remember the regulators crowing about that in front of Congress, that they'd done a great job, that was proof, right? In retrospect, that should have been proof that the system was on the precipice of collapse, not of a mark of success. Failure is a mark of success. I'm going to take my kids skiing over this weekend, and I'll be happy if one of them fall. If none of them fall over the whole weekend, maybe we didn't challenge ourselves quite enough. No trips to the hospital, no wipeout, little powder, it's okay. And so in that role, one. Two, how does that relate to the size of deposit insurance? During your tenure, deposit insurance, you started in 1980, which I would note was when it was raised from 40 to 100. It was raised again from 100 to 250, not as the result of an economic analysis on the optimal limit, but as an attempt to gain more votes for TARP after it had failed the first time. Your paper gave 3 ideas about deposit insurance, which is a great Rorschach test depending on which of the 3 you want. I thought you kind of hinted at your preferred in the speech of those 3. What do you think the deposit insurance limit should be? What do you think the role of bank failure in healthy capitalism is?
2 small questions, right? How much time do we have? So on the deposit insurance coverage issue, we did in our report, and if you have an interest in deposit insurance, I do recommend the report we did. It's very thoughtful. It really traces the whole history of deposit insurance, its evolution as part of the banking system of the United States, and sketches out options for change. It lays out 3 options. One, taking the limited coverage we have of $250,000 per account and raising it some amount to $500,000 to $1 million to $5 million to $10 million. That would be helpful to people with
a lot of money.
But frankly, from a financial stability standpoint, would still not do very much. It's worth keeping in mind that in the case of SVB, the top 10 depositors in Silicon Valley Bank held $13 billion with a B, $13 billion in deposits. So from a financial stability standpoint, bumping up the limit would not do much for financial stability. Second option, let's cover everybody.
Infinite deposit insurance limit, right? Is it Japan? There's a country that has that, I think.
I'm not sure Japan.
Yeah, I could be wrong. Which one?
That would certainly protect everybody, and it would put the government on the hook for every bank in the United States. It would be moral hazard, and I don't think anybody really views that as a practical solution. And the third option, which is the one we thought probably deserves the most consideration, and I mentioned it in the speech, are so-called business payment accounts. Those are both small and large companies keep payment accounts at banks for their payrolls. And those accounts, because they're so-called operational accounts, really need to be kept at one institution. You can't spread them out. So the moral hazard risk is really pretty limited. But the financial stability risk of paychecks not going out, depending on the size of the bank, it could be a given community, it could be a region, it could be consequential. So if you're going to look at a place to increase coverage that might not create undue moral hazard and have some financial stability benefit, that might be a place to look. And then it just becomes a question of how high the coverage should be. And that's really a function of how much is the industry willing to pay. Because the higher the coverage, of course, the larger the deposit insurance assessment. So there's a balance to be struck there. And there's also a big definitional issue of what is a qualified business payment account, but not insuperable. And I think that's an option that merits some consideration. And while I don't see anything imminent happening on Capitol Hill, I think there is some bipartisan interest in exploring that possibility.
So I think I know your answer to which of the three you prefer. Let me ask the audience questions that you have. Okay, we have a big side. Eli, the woman behind you there.
So you guys were actually listening through that whole thing. I appreciate that.
Thank you so much, Chair Gruenberg. It's really great to hear from you, and you will definitely be missed. My name is Tracy Lewis. I'm a senior climate policy counsel at Public Citizen. And not to keep you up anymore, but you noted that you have fears around a severe financial shock, and noticing what has been occurring in California could potentially represent a severe financial shock, a climate-related one. And would like to hear your thoughts on the climate financial risk of these really severe incidences that we've been seeing, and knowing that President Biden's climate EO is likely to be rolled back at 12:01 next Monday. Thank you.
No, thank you. Listen, I think the financial risks relating to climate are real and increasing. And we see it almost every day manifest itself in different climate events of increasing frequency and intensity, as well as an underlying transition that is taking place in the United States and around the world in terms of reliance on carbon-producing sources of energy. And I think large financial institutions understand that the evolving financial risk from climate is a real risk for them to understand and to manage. And it's a risk that is not going to diminish with time. It's a risk that's going to grow with time. And, you know, I think we need to take it into account in the risk management of our financial institutions. And, you know, the three banking agencies did establish a set of principles for the management of the financial risks relating to climate that are applicable to banks over $100 billion. It's important for banks to incorporate the management of climate risk into their underlying risk management framework so that it becomes a part and parcel of the routine risk management assessment. And large and small institutions are impacted. And so, you know, it's, you know, banks have been dealing with climate risk for a long time. It just hasn't been, you know, whether hurricanes, floods, droughts, wildfires, but the frequency and intensity are increasing, as is an economic transition in the United States and around the world. So I think it needs to be an important part of how our financial institutions think about risk management.
Yep.
Hi, I'm Mark Sheff with CQ Roll Call. I'm wondering, how do you think the proposal on bank control will evolve in the next administration, and what do you foresee on passivity agreements?
It's hard to predict. As you know, well, let's step back and just explain to everyone, in case they're not familiar. The banking agencies are subject to a law called the Change in Bank Control Act, which means that when a company gets more than a 10% ownership interest in a bank, it is deemed to have a controlling interest in that institution. So it has to either submit a notice to the regulator, notifying the regulator that they have control, and will then be subject to regulatory oversight because of the control that they have and are exercising, although they can have a rebuttal to that presumption of control by demonstrating that their ownership interest is passive and signing a passivity agreement with the regulator to ensure that the ownership interest is a passive one, that the company is not exercising management control, and that allows it not to be subject to the regulatory requirements that would come with control. And I think there's been, the FDIC has been subject to this law for some time. We have a few passivity agreements, and it's been a subject of interest for our board. And we recently signed a passivity agreement, as you know, with Vanguard. And to the extent other companies have controlling interests, direct or indirect, compliance with the law is pretty important, because from the FDIC standpoint, if some company has a controlling interest in a bank we supervise, we need to be aware of that and have some understanding of the relationship of that company to the insured institution that we supervise. So short answer is we'll see. To your question.
So we're over time. I see a lot more questions. We could continue this conversation for a long time. Final.
And Aaron and I have over the years.
And I expect we will continue. And in close, I want to ask you to give three things. One, what is the accomplishment that you're most proud of during your time at the FDIC? What is the thing that you hope your successor does? And what is the thing that your advice that you would give that your successor ought not to? So a do, a don't, and I'm really glad I did this.
So as you pointed out, I've been at the FDIC for a while. So it's hard to candidly pick one thing. I do take, well, if I may, a couple of things. I do think the work the FDIC did while I was on the board during the 2008 global crisis and during these regional bank failures in 2023 were central. In the first instance, to containing what could have been a real existential crisis for the U.S. financial system, and in the second, really what could have evolved but didn't, into a full-fledged systemic crisis. And I think the FDIC really made a difference, and the opportunity for me to participate in the response to both of those is something that I value. And more broadly, I'm going to mention three more things since you had multiple questions. Tick off three things. One, during the 2008 crisis, we had never thought about the resolution of a GSIB, of a global systemically important. I mean, literally, didn't have a clue, which is why we bailed them out. We didn't have any options. And paid an enormous price for it, even though we prevented the system from collapsing. So that fundamental objective was achieved, but at a very high price of bailing out those institutions. So the Dodd-Frank Act gave the FDIC really dramatic new authorities over the holding companies of GSIBs to place not just the bank, but the whole enchilada, the holding company, the subsidiaries, as well, in addition to the bank subsidiary, into a single FDIC-run resolution process, which was a starting point to even thinking about an orderly failure of one of these things with accountability, which didn't happen in 2008. And a bunch of other important authorities that we have worked hard on ever since, and I think we have made some good progress on. And both domestically in the United States and intense collaboration cross-border with some of our major foreign jurisdictions. So I think we are in a position today, I believe, to manage an orderly failure of one of these things. But, you know, we haven't done it yet. And so I think some humility is called for, let me say. And the example of Credit Suisse last year in Switzerland is not helpful. You know, Credit Suisse failed. The Swiss, it's been a lot of time. We worked with the Swiss closely on cross-border resolution, and they had the capability, we thought, but they didn't pull the trigger. I will say it is, for the first jurisdiction to look at the potential failure of a GSIB and be the first to pull the trigger on putting that company into resolution, that would give anybody pause. But it comes down to the confidence you have in the work you've done, the capabilities and authorities that you have, and your will to do it, and understand the importance of exercising that authority to the long-run interest of the financial system and the economy. So that's one. Two, we've done some wonderful and probably underappreciated work on community banks in the United States. Community banks really are vitally important to the financial system and economy of the United States. We just released a survey on small business lending in the United States. Community banks are still the heart of small business lending, which is a driver of economic activity in the United States. And the relationship model of lending followed by community banks is the dominant model for large and small institutions. And the small institutions actually do it better, frankly, than the large ones. And the FDIC, in addition to supervising the majority of community banks, and we've worked hard to promote new community banks, which we think have a lot of value, we've done a couple of studies in addition to this survey showing the real value to the U.S. economy and financial system of community banks. They really punch above their weight, and demonstrating that in a statistically meaningful way, not just, you know, anecdotes from people, which have value, but actually doing work to demonstrate the impact community banks make, I think has had a lot of value. And finally, the FDIC has done some foundational work on expanding access to the banking system in the United States. We initiated the survey of unbanked and underbanked households in the United States in partnership with the Census Bureau that established the first nationwide survey of who's unbanked and underbanked in the United States. It is the foundation. We established that in 2009. It's really the foundation of all the work that's been done on financial inclusion since.
I use it all the time.
And it breaks the unbanked numbers down, not just nationally, but by region and state and demographically, so that you can see the high disproportion of of unbanked households, for minority groups, for low-income households, for the elderly, with households with a person with disability, households headed by a single parent. Really a line of sight that we simply didn't have before that informs our efforts to expand access to the system. And as a follow-on to the survey, the FDIC developed what we called a model safe account, which is a low-cost transaction account. It's a debit card account, which gives the holder of that account a full account at an institution without check writing, which is the biggest cost to the bank, but allows the holder of the account to present themselves at the bank as a customer for access to credit and other services, access ATM machines, point-of-sale transactions. And the standards of the account are lower, no minimum balances, and low fees, including no overdraft fees. Those were the standards established by the account, and they have become remarkably popular by banks across the United States. And anyone who's familiar with the Bank On movement and their Bank On accounts, those Bank On accounts were modeled on the FDIC safe account. So I really think that was a valuable contribution that we've made. And I'm not taking credit for this, but in the release of the first survey in 2011, 8.2% of households in the United States were unbanked, outside of the banking system. In the most recent survey, it was 4.6%. So we have made real progress across the board for demographic groups, although the disparities, while lower for everybody,
Remain.
Still exist. So the challenge is still there, but we've really made a useful contribution. So if you ask the question, that's my answer.
Fantastic. Well, join me in thanking Chairman Gruenberg once again for this and for everything.
Thank you. That was great.